Enterprises has a financial year ending 31st December. The machine was bought for 2 million on 1st January 2020. Kizito intended to use the machine for 4 years. It was to be depreciated using the straight line method. Required the records for the depreciation of the machine for the 4 years, showing 1, depreciation for every year, 2, prepare provision for depreciation account. So we have provision for depreciation account. For the first year here, we have years here 2020, 20. The asset was bought on 1st January 2020. Can this allow me to adjust the question and include the, is it machinery? Machinery account. Roman 1, let's say we need to prepare also the machinery account. I want us to adjust the question and have more requirements. Machinery account. Let's also have machinery account. Roman 1, let Roman 1 be, Roman 2 be machinery account. This is Roman 2. Then provision for depreciation on machinery account, let it be Roman 3. Make that adjustment so that we also apply what we talked about, initial recognition. Remember we say that PPE is recognized at its cost, which include the purchase price, the transportation cost, the installation costs, and any other costs necessary to get the asset ready for use. Then we learned that there is also the subsequent measurement, where PPE is generally measured at its cost less accumulated depreciation. Cost less accumulated depreciation. So let's begin with the machinery account. So we read from the question that this machine was bought on January 1, 2020. When this machine was bought, the bank account was debited, machinery account debited. So we write here bank and debit the 2 million. That is the initial recognition, initial measurement. 2 million, debit machinery account. This is on first. The machine was to be used for 4 years. Kizito intended to use the machine for 4 years. So on 1st January, the machine is bought. Then on December 31st, what is the balance? Carried down is 2 million. So we close it. In 2020, 2 million, close that account. 2 million, close that account, because there is no any other activity or transaction in relation to this machinery in 2020. So the end of 2020, the balance is 2 million. At the beginning of 2021, January 1, we have a balance brought down of 2 million. So the period ends on December 31st. So we close this account, 2021, December 31. Balance at the end, we call it balance carried down, 2 million. We close that account like that. We close that account. That is in 2021. At the end of 2021, the balance is 2 million. Then we move to 2022. 2022, January 1, balance brought down is 2 million. Is any disposal or any other transaction in relation to machinery in 2022? No, there isn't. So we are going to close this account 2022, December 31, balance carried down 2 million. Close that account like that. Then we close this like that. This balance, this is the third year. Then the last year is 2023. January 1, balance brought down is 2 million. In 2023, December 31, balance carried down remains to be 2 million. We close this account, 2 million, 2 million. So these are 4 years. 1, 2, 3, 4. So that's what we mean by accounting for PPE, initial recognition. So the PPP account is always maintained at cost. Always maintained at cost. Always maintained at cost. So if there is any sale of this machinery, there could be many machines. Could be machine A, machine B, machine C. So anytime the machine is bought, we debit. If a new machine is bought, we debit. If a machine is sold, we credit the account. Because remember the double entry system, where any increase in asset, we debit the asset account. If there is a decrease in an asset account, we credit. So if there is an increase through purchase of machinery or an asset, we debit. But from the information we have, there were no additions and there were no disposals. So the machinery account was maintained at cost throughout the period of 4 years. Is that clear? Do you understand? The asset account, the machinery account, the PPE account.